What if I told you there's a way to make money in crypto that has nothing to do with predicting price movements, chart patterns, or even market trends? While everyone else is stressing about whether Bitcoin will pump or dump, there's a secret strategy that smart traders use to profit, regardless of market direction. And the crazy part? Most people have no idea this even exists. Listen up, because what I'm about to show you could completely change how you approach crypto trading. Right now, as I'm recording this video, the same cryptocurrency is trading for $14 higher on one exchange compared to another. Same asset, same moment in time, but completely different prices. This isn't some glitch or mistake. This is pure profit opportunity sitting right in front of everyone, but only a few people know how to spot it and capitalize on it. This is called crypto arbitrage, and it's not the outdated stuff you might have read about in some 2018 blog post. This is real-time dynamic opportunity hunting, where price gaps appear and disappear in seconds due to differences in trading volume, liquidity, and market activity across different exchanges. Let me break this down for you in the simplest terms possible. Imagine you're at two different gas stations, and one is selling gas for $3.50 per gallon, while the other is selling the exact same gas for $3.65 per gallon. If you could buy gas at the cheaper station and instantly sell it at the more expensive one, you'd make 15 cents profit per gallon with zero risk. That's essentially what crypto arbitrage is, except instead of gas, we're dealing with digital assets. And instead of driving between gas stations, we're moving between cryptocurrency exchanges. The beautiful thing about crypto arbitrage is that you don't need to be a technical analysis expert. You don't need to predict market movements, and you don't need to stress about whether the market is going up or down. You're simply taking advantage of temporary price differences that exist between different trading platforms. But here's where it gets really interesting. These opportunities happen way more often than you might think. The cryptocurrency market operates 24/7 across hundreds of different exchanges worldwide. Each exchange has its own order book, its own trading volume, and its own user base. This creates a constant flow of price discrepancies that create profit opportunities for those who know how to spot them. Let me give you some real examples of how this works in practice. Bitcoin might be trading at $97,850 on Binance, while simultaneously trading at $97,880 on Coinbase. That $30 difference might not seem like much, but if you're trading with $10,000, that's a $3 profit per Bitcoin, with essentially zero risk. Now multiply that by multiple trades throughout the day, and you can see how the profits start adding up. But here's the thing. These opportunities don't last long. We're talking about windows that might only be open for seconds or minutes before the market corrects itself. That's why successful arbitrage trading requires speed, precision, and the right tools to identify these gaps quickly. The key to profitable crypto arbitrage lies in understanding why these price differences occur in the first place. Different exchanges have different levels of liquidity, meaning some have more buyers and sellers than others. When there's a sudden spike in buying pressure on one exchange, the price might jump higher there, while other exchanges haven't caught up yet. Regional differences also play a role. An exchange popular in Asia might have different pricing than one primarily used in the United States due to varying demand patterns. Market news and events can also create temporary arbitrage opportunities. When major news hits, like a regulatory announcement or a big institutional purchase, some exchanges react faster than others. The faster exchanges adjust their prices immediately, while slower ones might take minutes to catch up, creating profitable gaps for alert traders. Now, let me address the elephant in the room: transaction fees and transfer times. Traditional arbitrage often gets killed by the fees involved in moving money between exchanges and the time it takes for transfers to complete. By the time your Bitcoin transfer confirms on the blockchain, the price gap might have already closed. This is where modern arbitrage strategies get creative. Professional arbitrage traders don't actually move assets between exchanges for every trade. Instead, they maintain balances on multiple exchanges and execute simultaneous buy and sell orders. When they spot Bitcoin trading higher on exchange A and lower on exchange B, they sell on exchange A and buy on exchange B at the same time. This locks in the profit instantly without waiting for any transfers to complete. Another advanced technique involves using stablecoins instead of Bitcoin or Ethereum for transfers between exchanges. Stablecoins often have faster transfer times and lower fees, making it more practical to move funds when larger arbitrage opportunities present themselves. The most sophisticated arbitrage operations use specialized software that monitors prices across dozens of exchanges simultaneously, automatically calculating potential profits after factoring in all fees and execution costs. When a profitable opportunity appears, the software can execute trades across multiple platforms in milliseconds. But you don't need fancy software to get started with crypto arbitrage. You can begin by manually monitoring prices on different exchanges for the same cryptocurrency. Start with major trading pairs like Bitcoin USD or Ethereum USD across popular exchanges like Coinbase, Binance, Kraken, and others. Keep a spreadsheet to track the price differences you observe and note how long these gaps typically last. One of the biggest advantages of arbitrage trading is that it's market neutral. Whether crypto prices are going up, down, or sideways, arbitrage opportunities continue to exist. While other traders are stressed about market volatility, arbitrage traders can actually benefit from it because volatility often creates more pricing discrepancies between exchanges. Risk management in arbitrage is different from traditional trading, but equally important. The main risks include execution risk, orders not filling as expected, transfer risk, delays in moving funds between exchanges, and counterparty risk, exchange issues or downtime. Professional arbitrageurs minimize these risks by maintaining accounts on multiple reliable exchanges, using automated execution tools, and never risking more capital than they can afford to lose. Let's talk about the profit potential, realistically. While arbitrage profits per trade might seem small, they can add up significantly over time. Professional arbitrage traders often target profits of 0.5% to 2% per trade, but they might execute dozens of trades per day. Even with conservative estimates, skilled arbitrageurs can generate monthly returns of 5 to 15%, with relatively low risk compared to traditional crypto trading. The learning curve for crypto arbitrage is actually quite reasonable. Unlike technical analysis, which can take years to master, the basic concepts of arbitrage can be understood in a matter of hours. The challenge isn't understanding the concept. It's developing the speed and precision needed to identify and execute profitable trades before the opportunities disappear. Technology plays a crucial role in modern arbitrage trading. Price monitoring tools, automated alerts, and execution software can give traders a significant advantage. Some platforms provide real-time arbitrage opportunity scanners that highlight profitable price differences across multiple exchanges, complete with profit calculations after fees. For beginners, I recommend starting with paper trading or very small amounts to get familiar with the process. Practice identifying price differences, calculating potential profits, and understanding the timing involved. Many exchanges offer demo modes where you can practice without risking real money. The regulatory landscape for arbitrage trading is generally favorable since you're simply buying and selling the same assets across different platforms. However, it's important to understand the tax implications in your jurisdiction, as frequent trading can have different tax consequences than long-term holding. Looking at the future of crypto arbitrage, opportunities are likely to persist as the market continues to mature. New exchanges are constantly launching, new trading pairs are being added, and institutional adoption is creating new patterns of price discovery. While some inefficiencies may decrease over time as the market becomes more efficient, new ones are constantly emerging. The bottom line is this: crypto arbitrage represents one of the most accessible ways to generate consistent profits in the cryptocurrency space without needing to predict market direction. It requires dedication, attention to detail, and proper risk management. But the fundamentals are straightforward enough for anyone to understand and implement. Whether you're a complete beginner looking for your first profitable crypto strategy, or an experienced trader wanting to diversify your approach, arbitrage offers a unique opportunity to profit from market inefficiencies that exist right now, today, across the global cryptocurrency ecosystem. The question isn't whether these opportunities exist. They absolutely do. The question is whether you're ready to learn how to spot them and act quickly enough to capitalize on them before they disappear. This is not financial advice. Always do your own research and never invest more than you can afford to lose. Cryptocurrency trading involves significant risks.